Here's something that sounds completely absurd until you actually do the math. If you invested $100,000 today and earned 7% a year for 30 years, you'd end up with roughly $761,000. Now, what if I told you that a fee difference of just 0.01% could cost you more than $30,000? That number is real, and it gets way worse from there. So today, we're breaking down exactly why expense ratios matter so much, which funds are quietly draining your portfolio, and the single most important number you should check before making any investment decision. This is the financial stuff they don't teach you in school. All right, let's start with the basics. An expense ratio is the annual fee that an ETF or mutual fund charges you just for holding it. It's expressed as a percentage of your investment. So if a fund has a 0.20% expense ratio and you have $10,000 in it, you pay $20 a year. Simple enough, right? Here's the problem. That small percentage doesn't stay small over time. It compounds against you year after year for decades. And the research on this is actually pretty stunning. In 2019, the investment company Institute published data showing that the average actively managed stock fund carried an expense ratio around 0.68%. Compare that to a simple S&P 500 index fund, which you can buy right now for as low as 0.03%. The difference is just 0.65%. Sounds tiny. But here's what that actually looks like in practice. Let's say you invest $100,000 and earn 7% gross returns annually before fees. With the actively managed fund at 0.68%, your net return is 6.32%. After 30 years, that $100,000 grows to about $642,000. With the index fund at 0.03%, your net return is 6.97%. Same starting money, same market. After 30 years, you're sitting on roughly $739,000. That difference is nearly $100,000, and that is from a fee gap of less than 1%. So why does this happen? It's compounding. The fee comes out every single year, which means you're not just losing that 0.65% once. You're losing it on a growing base. The second year, you pay the fee on a bigger balance. The 10th year, on an even bigger one. By year 30, you're paying a 0.65% fee on a portfolio that's 6 or 7 times larger than when you started. The fee scales with your wealth, which means the damage scales with your wealth too. Now here's where it gets really interesting. Most people think the difference between a 0.1% fund and a 0.2% fund is negligible. And for 1 year, it basically is. $20 versus $10 on $10,000. But over 30 years, it is not even close. Let's look at a real-world example. The Vanguard S&P 500 ETF, ticker VOO, currently has an expense ratio of 0.03%. It's one of the most popular ETFs in the world, with over $1 trillion in assets under management as of 2024. Compare that to the average large cap blend mutual fund, which, according to Morningstar data, sits at roughly 0.82%. That gap is 0.79%. On a $500,000 portfolio earning 7% annually, that 0.79% difference costs you approximately $718,000 over 30 years. $718,000. Think about what you could do with that money. That's a house in most American cities. That's early retirement. That's generational wealth. And it came from choosing a fund with a lower expense ratio. If you're finding this useful so far, hit subscribe. I drop videos like this every single week, and the next one is going to blow this one out of the water. Okay, so we've established that fees compound against you. Now let me show you the one that nobody talks about. The reason expense ratios matter so much isn't just that they reduce your returns. It's that the difference between funds compounds asymmetrically in favor of the market. What do I mean by that? Most actively managed funds don't beat their benchmark index after fees. The SPIVA scorecard, published annually by S&P Dow Jones Indices, has tracked this for over 20 years. As of their 2023 report, over 89% of large cap managers failed to beat the S&P 500 over a 20-year period. 89%. So not only are you paying higher fees for an actively managed fund, you're paying higher fees for a fund that most likely underperforms a cheap index fund anyway. You're paying double. The fee itself and then the performance gap. Vanguard's founder Jack Bogle understood this intuitively. He launched the first index mutual fund for individual investors in 1976. At the time, the financial industry mocked him. They called it Bogle's folly. The press said individual investors would never accept lower returns and fewer options. Jack Bogle's response was simple. He said, "Don't fee yourself." 3 words that contain an entire investment philosophy. Because here's what most people miss. The market return is the market return. You cannot control whether the S&P 500 goes up or down in a given year. Nobody can, not consistently. but you can control what you pay to access it. And that control is one of the only variables in investing that you can actually influence. It is entirely within your power to choose a fund with a lower expense ratio. And over a long enough time horizon, that single decision could be worth more than any stock pick you will ever make. So here's the practical part. What should you actually do? First, check your current funds. Every ETF and mutual fund is required to publish its expense ratio in its prospectus and on its website. It's usually listed as an annual percentage. If you're paying more than 0.2% for a basic index fund, you're probably overpaying. Second, compare alternatives. For a US total market fund, you have options like the Vanguard Total Stock Market ETF at 0.03%, the iShares Core S&P Total US Stock Market ETF at 0.03%, and the Schwab US Total Stock Market ETF also at 0.03%. These are all essentially free to hold compared to the actively managed average. Third, look at the fee difference, not just the fee. When you're comparing two funds, multiply the expense ratio difference by your portfolio balance and by the number of years you plan to hold it. That calculation will tell you exactly how much the fee difference costs in real dollars. And once you see that number, I promise you will never look at expense ratios the same way again. Here's the bottom line. The difference of 0.01% sounds like nothing. It sounds like rounding error. It sounds like something only a spreadsheet nerd would care about. But over 30 years, on a real portfolio, with real compounding working against you, that 0.01% is worth real money. Tens of thousands of dollars. And if you stack that up across your entire investing lifetime, the fee savings alone could rival the returns from your actual stock selection. So the next time someone tells you that fees don't matter as long as you pick the right fund, remember Jack Bogle. And remember the 89% of professional managers who couldn't beat the index even when they tried? The simplest edge in investing isn't picking the right stock. It's not paying more than you have to. If this video saved you money or changed the way you think about investing, share it with someone who still thinks expense ratios don't matter. And subscribe if you want to keep building your financial literacy one video at a time. I'll see you in the next one.